Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Jeff Atherton, lead manager of the Man Japan Core Alpha Fund, which features on our wealth shortlist of funds selected for their performance potential. So Jeff, thanks for joining us. The Man Japan Core Alpha Fund invests in larger, established Japanese companies that are currently unfashionable or out of favour with the market. What do you see in those types of companies, and more broadly, why do you have that value style of investing?
Okay, well, first of all, thank you, Joe, for inviting me here today. Well, if you look at, we've got a process which has been developed over many years, and it goes back to the 1990s, mid-1990s. This particular product that we're talking about started nearly 20 years ago in early 2006. And if you look back historically, Japan has been a market that rewards value and contrarian investing. The data shows you that it's better in Japan than particularly in the States. And we think there's a lot more mean reversion in a market like Japan. And the fund really tries to benefit from that. And there's a long history of that being quite successful in Japan. Of course, that doesn't guarantee success in the future. But if you look at the data going back a long way, and we've got data back to about 1980, I think, then that style that we have of being a value-focused contrarian investor has historically worked in Japan. And that's why we picked it up many years ago, and we've been running for a long time, and I think historically it's worked more often than it hasn't.
And that value style bias is really quite distinct in the funds, and kind of interested to hear about periods where that's been out of favour with the market, and for you as the manager, how difficult is it to kind of stick to your knitting during those periods where the market's going against you?
That's a very good question. It's tricky. If you go back, there have been two periods really when value struggled. The first was, for those with a long memory, was back in 1999 when you had the famous sort of TMT boom with the internet first coming along as an idea. And value struggled. It was quite severe, but it was quite brief, maybe 18 months, and then value recovered nicely and started to win. And then the second period that value was difficult really was from the coming out of the Lehman shock in April 2009, and central banks flooded the markets with liquidity, the famous QE. And from 2009 until really the end of 2020, through the COVID period, value was more difficult. And we put that down to excess liquidity, which favoured a lot of the longer duration, sort of technology growth type names. So we've been through a number of cycles over many years, and there are times when it's more difficult for it to work. I think what we don't do is change the process. We don't change the philosophy, and we think that you can win by being contrarian and value focused. So what we try and do in practice, I guess, is just slow down the process. Be aware that it's sort of the wind is in your face rather than at your back. And what we're trying to do to remind people is really buy things when they're depressed relative to their history, they're out of fashion. When they come back into fashion and mean revert, we sell, and we sort of find the next ones to reinvest into. And I think when you're out of favour, generally, probably the key to this is to keep those winners longer, and just to be very careful about how quickly you reinvest into the unfashionable areas, because they can stay unfashionable for longer than you think. So it's not changing the process, it's almost just putting it in slightly in slow motion. We always have some winners that we've bought previously, maybe 4 or 5 years ago, so there are always parts of the portfolio that are winning. So it's not everything is at this moment in time sort of contrarian and out of fashion. So it's a question of, just being careful about how aggressively you sort of push forward the process.
And for investors in Japan, an interesting theme in recent years has been evolving standards of corporate governance, and more so in favour of shareholders in recent years.
Yep.
So as an investor in the region, interested in your perspective, and maybe an example of a company where that trend has been on display?
Yeah, I think it's a very key driver of the market, and it's certainly happening. Some good examples would be Sony. It started quite early, back in 2012, and that market cap has gone from sort of $10 billion to $150 billion. So just better managed, got rid of the parts that don't work, reinvest in the parts that do work. So it's really being focused on doing things that enhance the share price, and maybe not doing things for historical reasons. So, I've been doing the market now for 35 years, and I do think this is probably the most important thing that's out there. And if you do it correctly, then the market is very binary and will reward those companies sometimes excessively for what they're doing. I mean, Hitachi is a more recent example of a stock which has completely transformed its image. But yeah, it's an exciting part of the market, and we think it's the single most important thing that's going on.
And is there anything you sort of put your finger on as to, the trigger to sort of kick-start in that process?
I think it goes back really to 2012. Japan was worried it was going to be the next Greece with the fiscal position. And I think they realised that they had to change things. And a lot of the corporates were too small in terms of global market cap and their ability to compete on the global stage. You've got the rise of China and the rest of Asia and Korea and Taiwan, very strong competitors. And I think they realised that they had to generate more cash, get the stock price up, and then you can access the capital markets and you become strong enough to put the R&D and the capex, which keeps you going. So it came from the Japanese, and I think it was coming from the realisation that they were going to fall further behind in Asia, in particular, if they didn't change. And so it's driven by themselves. I mean, there's a separate sort of activist movement which is a little bit in parallel, but if you think the sort of sustainable stuff is coming from within the Japanese corporates themselves, and they know they have some formidable competitors in China. You just look at how quickly they've developed certain products, that they have to up their game, and that's what they're trying to do.
And Japan as a investment destination has been sort of overlooked in recent years. Other regions have dominated the headlines to a much greater extent, obviously the US being the major one. So I guess thinking more broadly, what does the fund and more broadly an investment in Japan offer to an investor's portfolio who's sort of considering where to invest today?
Yeah, I mean, that's a good question. I don't think we try to sort of compete head on with the US. I think the US is its own thing. It's quite dominant and has a particular type of company. I would always compare us to Europe as a destination. I think it's got a lot of similar characteristics. I think the advantage, hopefully, that Japan has got over Europe is firstly, it's a single entity, so you don't have to have 29 countries or whatever it is trying to agree on things. But I think also it goes back to this corporate governance story, and I think a lot of what's happening in Japan now is similar to what happened in Germany, for example, in the early 90s. And they had a lot of the same setup as Japan has now, so a lot of cross-shareholdings and the banks being very sort of central to what's going on. So I would say that we are like Europe was 20 years ago. And the upside, if it is sustained and if it happens, is that Japan becomes more world-class in terms of its company's behaviour, its return on capital, allocation of capital, operating margins, cash flow, etc. So that's the upside, I think, is that Japan becomes world standard. They say the US I regard as slightly separate, but there's no reason why Japan can't do as well as Europe or even the UK in terms of the operating metrics. So it'll be a long-term story. And not every company can do it, but I think the potential is there for a lot of Japanese companies to earn better returns, and the share prices should, I suspect, will reflect that over time.
And you spent decades analysing Japanese companies. What would you say has been the kind of the key lesson you've learned along the way, through that process, and something perhaps, if you could rewind back to when you started, might have been useful to know back then?
Yeah, I mean, it's not specific to Japan, but I think one of the things that I've hopefully learned over a long period of time is that, the market's normally ahead of you. And I think people sometimes come into the stock market and they look at things and they see either a good thing or a bad thing and they react. And I think what I've sort of seen over a long period of time is that by the time you are thinking about and trying to react to something, the market's probably there already. And that's one of the important things. The market's sort of kind of all-seeing, all-hearing beast, and it knows things. But at the same time, it's a very, I think, emotional beast. It's either very depressed or it's very elated, and this sort of fear and greed, I think, is one of the things that you can exploit, across a whole series of stocks and sectors over a long period of time. But if you get to the stage where you think something's really bad, I mean, COVID and sort of lockdown was a good example that by the time we realised it was looking really terrible, I mean, the stock markets, they bottomed out within 2 weeks. The market was there. And the thing to do actually with hindsight was to buy into that lockdown, not to go safe. That would have been too late. So yeah, I think that's probably the thing that I've learned over a long period of time is, yeah.
And who would you say has had the biggest influence on you as an investor and on your approach?
I think if you look at the strategy, it was founded by a guy called Steve Harker. And as I said earlier, he started in the mid-1990s, and he was, I think, way ahead of his time in terms of the whole value versus growth, and large caps versus small caps, and the whole sort of factor investing. And he hired me at the back end of 2000, and I worked with him at a place called TCW in early 2001. So before the launch of Core Alpha. So I've been looking at this process for nearly 25 years now. But I think what Steve did was he put down in a very structured and clear way what I was probably doing in a haphazard and slightly unstructured way, and he introduced me to the whole concept of style investing, and it just sort of, I think, you know, I felt I could see more of the market, and there are specific dates when things happen. You know, we were talking before about, you know, one of the turning points for value in 2000 was when Pfizer announced the COVID vaccine. And there are specific days when things change, and I think Steve was extremely good at sort of pointing out dates that were really pivotal in financial markets, and a lot of people, I think, missed that. So, yeah, just the structure, the clarity, the consistency of style, in our case, value investing, and I think he was very influential and very ahead of his time.
And outside of work, how do you switch off?
Yeah, I mean, it's fairly simple. I mean, I'm lucky enough to live up in North Yorkshire. It's nice and rural, so I play a bit of golf. There's, you know, I take my dog for a walk, and that's really therapeutic and clears the head, and I can be out for 2 hours and see 4 people. So I like that, and for a long time I've been very interested in military history. That's my sort of great hobby outside of work. But yeah, so simple stuff, but it works for me.
Great. Jeff, thank you very much for joining us.
Okay, thank you, Joe. Thanks.